Your investment portfolio right now is probably a mess. Not because you made a bad choice, but because the market has been doing its thing. Some investments have soared through the sky, while others have dropped through the roof. What started as a balanced 60 to 40 portfolio might now be 75 to 25, or even worse. And here's the kicker: an unbalanced portfolio could cost you thousands in missed gains or expose you to way more risk than you're comfortable with. Let me show you exactly how to fix it. Welcome back to KP Money Talks, and today we're doing a complete walkthrough of how to rebalance your investment portfolio in 2026. Step by step, no fluff, just actionable strategies you can implement this week. Whether you're a beginner investor or you've been in the game for years, rebalancing is one of the most important habits for long-term wealth building. Hit subscribe if you want investing advice that actually makes sense. Let's dive in. First, let's talk about why rebalancing matters. Because if you don't understand the why, you won't stick with the how. Rebalancing is the process of buying and selling portions of your portfolio to bring it back to your original target allocation. Let's say you started 2023 with a simple portfolio, 60% stocks and 40% bonds. Over the past 3 years, stocks have significantly outperformed bonds. So now, without even you doing anything, your portfolio might be 75% stocks and 25% bonds. That means you're taking on 25% more stock market risk than you intended. If the market crashes tomorrow, you're overexposed. Now let's talk about the benefits of rebalancing. Benefit 1, the risk management. Rebalancing keeps your risk level aligned with your goals and comfort zone. You don't accidentally become a high-risk investor just because tech stocks had a great run. Benefit 2, forced discipline. Rebalancing forces you to buy low and sell high. You're selling assets that have performed well when they're expensive and buying assets that have underperformed when they're cheaper. It's counterintuitive, but it works. Benefit 3, long-term performance. Studies show that rebalanced portfolios have outperformed set and forget-it portfolios over the long term, especially during volatile markets. The key insight is that rebalancing isn't about timing the market, it's about maintaining your strategy through market cycles. Alright, let's get tactical. Here's the exact process to rebalance your portfolio. Step 1. Review your current allocation. Log into your investment accounts, brokerage, 401k, IRA, TFSA, whatever you have, and pull up your portfolio. Most platforms have a holdings or asset location view that shows you what percentage of your portfolio is stocks, bonds, real estate, cash, etc. Write down your current allocations, for example, stocks 75%, bonds 20%, cash 5%. Step 2. Define your target allocation. What should your portfolio look like based on your goals, timeline, and risk tolerance? General rule of thumb is subtract your age from 110 or 120 to determine your stock allocation. If you're 30, you might aim for 80 to 90% stocks and 10 to 20% bonds. But this is personal. You should consider how long until you need money. How much risk can you stomach? What are your financial goals? For example, set your target allocations to stock 70%, bonds 25%, and cash 5%. Then step 3, calculate the difference. Now compare your current allocation to your target. Your current allocation is 75% stocks and your target allocation is 70% stocks. The difference is you need to reduce stocks by 5%. Then comes to bonds. Current is 20% bonds and target is 25% bonds. The difference is you need to increase bonds by 5%. If you have $100,000 in portfolio, that means selling $5,000 in stocks and buying $5,000 in bonds. Now then, go to step 4. Choose your rebalancing method. You have 3 options. Method 1 is sell and buy. Sell the overweight assets and use the proceeds to buy underweight assets. This is the most direct method, but can trigger taxes in taxable accounts. Method B is use new contributions. Instead of selling, direct new contributions towards underweight assets until balance is restored. This is tax efficient but kind of slower. And then method C, hybrid approach. Use new contributions for small adjustments and only sell when allocations are significantly off, 5 to 10% or more. For most people, I recommend method C. It's tax efficient while keeping your portfolio reasonably balanced. Then step 5, execute the trades. If you're rebalancing within a retirement account like an IRA or 401k, this is a great news. No tax consequences. Buy and sell freely. If you're in a taxable account, you need to be a little more strategic. You need to consider tax loss harvesting opportunities, avoid selling positions you've held less than a year, prioritize rebalancing with new money when possible. Place your trades to bring your portfolio back to target allocation. Last but not least, step 6, document and schedule. Write down what you did and when. Set a reminder for next rebalancing session. Most investors should rebalance once or twice a year, depending on the common approach, while allocations drift between 5 to 10% from target. That's like a threshold approach. And you should do it quarterly if you're actively managing a large portfolio. Don't rebalance more than quarterly unless you're a very active investor. You'll rack up unnecessary transaction costs and taxes. Let me save you from making mistakes I see people make constantly. Mistake 1, rebalancing too often. Every time you sell in a taxable account, you potentially trigger capital gains taxes. Rebalancing monthly or even quarterly is usually overkill for most investors. Stick to once or twice a year unless your allocations are severely out of whack. Mistake 2 is ignoring tax consequences. If you have $50,000 in gains and you sell to rebalance in a taxable account, you could owe $7,500 to $10,000 in capital gains taxes. Always rebalance first in tax-advantaged accounts like IRA 401ks, where there are no immediate tax consequences. Use taxable accounts only when necessary. Method 3, chasing last year's winners. Don't rebalance into last year's hot sector just because it performed well. The whole point of rebalancing is to maintain your strategy, not chase performance. If tech stocks crushed it last year, they're now overweight in portfolio. You sell them to rebalance and you don't buy more. Mistake 4, forgetting about all accounts. Look at your entire portfolio across all accounts. Don't rebalance your IRA in isolation while ignoring your 401k and taxable accounts. Your target allocation should apply to your total wealth, not individual accounts. Mistake 5, setting it and forgetting it forever. Your target allocation should evolve as you age and your goals change. A 25-year-old and a 60-year-old shouldn't have the same allocations. Review your target allocation annually and adjust as needed. Here are some advanced moves to level up your rebalancing game in 2026. You can use robo-advisors for automatic rebalancing. Platforms like Betterment, Wealthfront, and others automatically rebalance your portfolio for you. If you want a hands-off approach, this is worth considering. Consider tax loss harvesting while rebalancing. If you have positions at a loss in your taxable account, sell them to offset gains elsewhere. Rebalance and reduce your tax bill at the same time. Rebalance with dividends and distributions. Instead of automatically reinvesting dividends into the same funds, redirect them towards underweight positions. This keeps your balance without triggering sales. And keep it simple. The more complex your portfolio, the harder it is to balance. A 3-fund portfolio, which means total stock market, international stocks, and bonds, is way easier to maintain than 15 individual stock positions. Simplicity is underrated in investment. Alright, here's your action plan for the week. Number 1. Review your current portfolio allocation across all accounts. Number 2. Define or confirm your target allocation based on your age and goals. Number 3. Calculate what needs to adjust. And 4. Execute rebalancing trades, prioritizing tax-advantaged accounts. And number 5. Set a calendar reminder for your next rebalance. That should be around 6 to 12 months. Rebalancing isn't exciting, but it's one of the most important habits successful investors practice consistently. If this video has helped you in any way, smash that like button and subscribe for more investing strategies that actually work. Drop a comment below. And thank you for watching. I'll see you in the next one.